The quickest way to go broke is to try to be a hero. It is the desire to buy at the absolute lowest tick of a panic, to catch the very bottom of a crashing market that has emptied more accounts than any bear raid in history. The public sees a stock that has fallen from $100 to $50 and thinks it is a bargain. When it falls to $30, they are certain it is the opportunity of a lifetime. They rush in to buy the first sign of green, the first little rally, believing they have outsmarted everyone. In doing so, they are not buying a bottom. They are stepping in front of a freight train that has merely paused for breath. The market is not a game of catching falling knives. It is a game of identifying the moment a trend has definitively ended and a new one has begun. These are two vastly different things, and confusing them is financial suicide. The average man does not want to be told that this is a bull or a bear market. What he desires is to be told specifically which particular stock to buy or sell. He wants to get something for nothing. He does not wish to work. He does not even wish to have to think. It is my belief that the public has always been and always will be stampeded by its own hope and greed. This is never more true than at the bottom of a sharp decline. His hope that the pain is over compels him to act on the first evidence of relief. This is a fatal impulse. All my experiences, paid for with millions of dollars of my own money, are detailed in the book written about my life, Reminiscences of a Stock Operator. I suggest you read it not as a story but as a textbook on the market's immutable laws. You can find a link in the description of this video. It is the price of a book against the price of your ruin. Let me tell you about a time I learned this lesson with my own skin. It was after the great San Francisco earthquake of 1906. I was in Atlantic City, away from the noise of Wall Street. When the news came, I did not think of the tragedy. I thought of the market. I knew, with absolute certainty, that the market would have to break, and break hard. But then I thought further. I knew that after the initial panic, a city like San Francisco would be rebuilt. It would require steel, equipment, and transportation on a massive scale. Union Pacific, the great railroad, would be instrumental. The stock was a screaming buy, but not yet. First, it had to endure the panic. I reasoned that after the liquidation, it would be the buy of a lifetime. I waited. The market broke as I expected. Then Union Pacific began to rally off its lows. It was a sharp, aggressive bounce. This was the moment, the classic V-shaped bottom that seduces the amateur. Here was my chance to be a hero, to buy the stock I knew was destined for greatness at a panic price. I bought it, and I bought it in size. It felt correct. The stock was moving up. I had caught the turn. Then the market turned against me. The stock began to slide again. This selling was not a panic. It was a cold, calculated pressure. It was the intelligent selling of insiders and large operators who understood that the first rally was merely short covering and the buying of hopeful amateurs like myself. They knew the market had to test that low again, to shake out all the weak hands who had bought the initial bounce. They pushed the price down and down and down, right through my entry point. I was forced to sell my entire line at a considerable loss. I was furious. I had been right about the ultimate direction of the stock, but I was wrong about the timing, and in the market, being wrong about timing is the same as being wrong about everything. A few days later, after the secondary selling had exhausted itself, Union Pacific began its real advance, the one that went on to make new highs. The great bull move started not from the initial panic low, but from the successful retest of that low. I had paid a fortune for the lesson that the V-bottom is a liar. You must understand why this happens. A sharp, violent drop in prices creates a vacuum. It is unnatural. The first rally, the upward stroke of the V, is almost always a technical reaction, not a change in character. It is caused by two groups, shorts and bargain hunters. The speculators who were short the stock during its decline see a quick profit. They rush to buy back their shares to lock it in. This buying creates a sudden, sharp demand. At the same time, the public, the bargain hunters, see the stock down 50% and jump in thinking they are clever. This combined buying pressure creates a fast, energetic rally. But it is hollow. It is built on a foundation of sand. Once the shorts have finished covering, their buying pressure evaporates completely. Once the first wave of bargain hunters are in, their capital is spent. Who is left to buy? The rally stalls. The stock begins to drift downward as the natural weight of the market takes over again. This is the moment of truth. This is the retest. Several things happen during this secondary decline. First, the bargain hunters who bought the V-bounce are now losing money. Their brilliant trade is turning red. Fear replaces greed. They held on through the whole crash, but they cannot stand a loss on their perfect bottom call. They sell, adding to the pressure. Second, more sellers who were too slow to act during the panic now see this rally as a gift. A second chance to get out at a better price than the lows. They begin to unload their shares. This is real, deliberate selling, not panic. This is where the composite operator, the embodiment of smart institutional money, steps in to observe. They did not buy the panic low. They did not chase the V rally. They stood aside and waited. Now, as the stock drifts back down, they watch the tape, which is your modern price and volume chart. They are asking one question. Is there still a great supply of stock for sale? If the stock falls back to its old low on heavy, aggressive volume, it tells them the liquidation is not over. The sellers are still powerful. The line of least resistance is still down. They will not buy. But if the stock drifts back down toward the old low on very light, drying up volume, it is the most bullish signal in the world. It tells the operator that the selling pressure is exhausted. Everyone who was scared has sold. Everyone who wanted out is out. There is no more stock being pressed for sale. The secondary test has been successful. The stock has held. Now, and only now, is the foundation for a real advance laid. The line of least resistance is beginning to turn upward. Your job as a speculator is not to predict this, but to recognize it after the fact. My system of trading, my entire philosophy, is based on waiting for the market to confirm my opinion before I risk my capital. Buying a V-bottom is betting on an opinion. Buying a successful retest is betting on a confirmed fact. The fact is that selling has dried up. The pattern you're looking for is not a V, but a W. The first downstroke is the panic. The first upstroke is the fool's rally. The second downstroke is the crucial retest. The second upstroke is the one you must trade. Your entry point, your pivot point, is not the low. It is the price level at the peak of that first fool's rally. When the stock, after successfully testing the low, rallies again and pushes through that middle peak of the W, it is the signal that the character of the market has changed. The buyers are now in control, and they have absorbed all the sellers. This is the point of minimum resistance. This is where you should place your bet, and place it with conviction. I learned to never anticipate the market. I had to wait for the ticker tape, your price chart, to tell me what to do. The tape is the final authority. My initial losses in the bucket shops, which were fraudulent brokerages of my time that bet against their customers, came from betting on my own opinion of what the tape should do. My great successes came when I learned to simply obey what the tape was doing. The tape will tell you that a V rally is weak by the character of its subsequent reaction. A true bull move does not begin with a rocket launch from the depths. It begins quietly. It begins with a period of accumulation where the stock goes dead, trading in a narrow range on low volume after a decline. This is the smart money absorbing shares. The W bottom is the visible, charted evidence of this accumulation process taking place. The V bottom is evidence of a short covering panic and nothing more. Think of it in terms of building a house. A V bottom is like trying to build a skyscraper on a foundation of mud. The first few floors go up fast, but the entire structure is unstable and doomed to collapse. A W bottom, or a basing period, is the process of pouring a deep concrete foundation. It is slow, boring, and unspectacular, but it is the only foundation that can support a significant advance. You do not want to buy the mud. You want to buy the stock only after the concrete has set. The signal that the concrete is set is the breakout above the midpoint of that W. The psychology of the trader who chases the V-bottom is flawed. He is driven by ego. He wants the glory of having bought the absolute low. He wants to tell his friends he bought XYZ at $10 right before it went to $50. It is a story, a fantasy. A professional does not care about stories. He cares about his bank account. It is far more profitable to buy XYZ at $15 after it has proven its bottom at $10 and ride it to $50. You sacrifice the first few points of the move in exchange for an infinitely higher probability of being correct. The professional speculator is not in the business of being a hero, he is in the business of being right. The first principle is not to lose money. Buying into an unconfirmed V-shaped rally is one of the surest ways to violate that principle. Let me be perfectly clear about the rule. It is an unbreakable one. After a stock has suffered a severe and rapid decline, you must not buy its first rally, no matter how sharp or convincing it appears. You must let that rally exhaust itself. You must then wait for the stock to decline and retest its previous low. This secondary decline is the most important part of the entire pattern. You will watch the volume. If the volume on the retest is significantly lower than the volume on the initial panic low, it is a sign that the selling is finished. If the stock then holds that low and begins to rally a second time, you have your setup. Your entry signal is not the low itself. Your entry signal is when the price decisively breaks above the high point of that first initial rally. This is the safest, most logical, and most profitable way to trade a market reversal. You're acting on confirmation, not anticipation. You are following the path of least resistance, a path that the market itself has just finished clearing for you. Do not be the hero who tests the path for landmines. Be the general who marches his army down the road once it has been proven safe. That is how you survive, and that is how you profit. The market pays for patience, not for bravery.